Now it is my great pleasure to introduce Jason Richardson. Jason serves as Director of Research and Evaluation at the National Community Reinvestment Coalition, or NCRC. We like our acronyms. Jason is distinguished in his field as a geographer who has done extensive research on mortgage finance and its impact on people and communities. Before coming to NCRC, he was a researcher with the NAACP. Jason spent over 2 years documenting and meeting with banks to discuss their investment in minority communities. In this capacity, Jason developed new and powerful methods of identifying minority clusters at the neighborhood level that are often overlooked by mainstream banks and non-bank lenders. LHUB is excited to have Jason speak on Lancaster and York's Fair Lending Report. Thank you for joining us this evening, Jason.
Hi, this is Jason Richardson. I'm the Director of Research for the National Community Reinvestment Coalition. Today we're going to be talking about a report that we prepared on Lancaster and York counties in Pennsylvania. We're going to go through this pretty quickly, but we're going to have time for Q&A after I speak. And then in the chat, if you look now, there should be a link that lets you follow along with this report yourself. But first, let's take a look at the demographic profile for Lancaster and York counties. Here we have the total population, as well as the number of neighborhoods or census tracts, income, and racial demographics. And if we look at a detail of these areas, we look at neighborhoods where they are majority minority, or neighborhoods that are low or moderate income, or LMI. Overwhelmingly, these counties are majority white and majority middle or upper income. However, there are significant numbers of people living in low to moderate income neighborhoods. About half of those are white. The rest are mostly Hispanic or Black. As we go through this presentation, we're going to talk about a lot of lending and branch locations, and it's important to remember the demographics of the area that we're talking about as we go through it. So first, let's look at mortgage lending. We look at 2018 and 2019 data here from the Home Mortgage Disclosure Act. 48% and 46% each year were home purchase loans. The rest were a mixture of refinance lending and home equity or home improvement loans. What's important to note here is that nationally in 2019, interest rates dove quite a bit. So refinances were typically much more of the lending profile in most communities. That was not the case here in Lancaster and York. Home purchases remained the largest share of mortgage lending that we saw. When we look at where those loans are distributed, we compare the lending with the underlying income and race of the population. In this case, this map looks at home purchase loans to low to moderate income borrowers in purple, middle and upper income borrowers in orange, and we're comparing it with the income of the census tract or the neighborhood that the loans took place in. Darker greens indicate upper income, lighter colors indicate lower income. Generally, this pattern is exactly what we expect to see, with a concentration around the urban areas, and then it thins out as you get into the more rural parts of the counties. However, you do want to take a look at the inset maps. In particular, York sees virtually no home purchase lending within the city limits itself, where we see most of the city is lower income. That also matches if we look at the mortgage, the next map, which looks at the racial composition of the neighborhoods, where in York, where it's a higher minority population that we know is low income, there is no lending activity there. Lancaster actually shows a somewhat decent pattern of lending in these areas, although they are higher minority in population, though, and the loans tend to go to white borrowers. We can take a closer look at a detail of where the loans are occurring here, and what we're doing now is we're looking at the total amount of the population living in low to moderate income and majority minority neighborhoods, and then the share of loans going into those neighborhoods. And because of the demographics of the area, the percent of families living in low to moderate income or majority minority neighborhoods is actually quite low. But still, we're still not seeing quite as many loans in these areas as we would hope. In particular, the majority minority tracts, although limited, include 6% of the population, yet are only receiving 3% of the loans. That's a very small share, and it's it's not really where we'd like to see it. And this is kind of backed up by the map, especially the map of York, showing those majority minority neighborhoods with no lending. Let's take a look at who the top lenders are, and these are the top 20 lenders. We're going to actually focus here on home purchase loans. So when you're following along with this at the link that I put in the chat, you can go here, click on home purchase, and it'll give you the total number of loans for home purchases that were made by the top 20 banks. Now, some of these are originations. In blue, these are loans that Wells Fargo made themselves. In pink, this is the total of loans that Wells Fargo purchased from other lenders in the area for home purchase loans. So as you can see, for Wells Fargo in particular, purchased loans are a huge chunk of their business, and they're an important part of lending for any community. However, due to limitations to the data, we don't really look at purchased loans very much. And the reason is that many lenders remove information on borrower race and income from those loans. So it makes it a little bit difficult to analyze. So from here on, we're going to focus just on the origination of loans here. One thing of interest is that you'll note that Wells Fargo, although it's the largest bank lender in the country, are not originating as many loans as several other lenders in the area. So let's take a look just at those originations. And again, we're looking at the top 20 lenders. Let's hold it with home purchase loans. Fulton Bank is the largest originator in the area. Most of the loans are conventional. However, here at the end, you'll see a significant portion of their loans are made using FHA or VA or RHS government insurance programs. Generally speaking, throughout the U.S., very few banks make a lot of government-backed loans anymore. They mostly focus on the conventional space, and they leave the government-backed lending to non-banks or mortgage companies. In fact, if we look here, if we narrow this back down just to the top 20 banks in the area, you're going to see that except for the top 3, very few of the other banks actually make very many loans using government insurance. And we can compare that with mortgage companies, which overwhelmingly make a large portion of their loans using government insurance of one form or another. And let's take a look at a couple of things here. First, we're looking here at the distribution of loans to the largest racial groups in the area. And we're looking at home purchase loans. This is the percentage of loans using government insurance by race. What you'll note here is that Black and Hispanic borrowers overwhelmingly rely on FHA, VA, or RHS loans for their home purchases. This is similar to the pattern we see throughout the country. Even when we isolate it by income, let's say we just focus on middle and upper income borrowers, it still is apparent that the vast majority of Hispanic and Black applicants are reliant on government insured loans, especially when compared to white or Asian borrowers where those numbers are quite a bit lower. Even if we focus on low or moderate income families, although a higher share of white borrowers need government insured loans for their home purchases, it's still pretty low when compared to Black and Hispanic borrowers. And let's take a look here and see. So why do we care? Why do we care about the type of loan that somebody gets to buy a home? And a big reason we care is the cost. So these are closing fees and interest rates for home purchase loans. And we're comparing conventional loans with the 3 different types of government insurance. The first red flag that should really jump out here is the enormous difference in closing fees. Average closing fees for home purchase loans, conventional loans, $1,700 compared to over $6,500 for FHA borrowers. This is important for a few reasons. Closing fees are one of the largest barriers to home ownership. It takes years for borrowers, especially first-time borrowers, to save up the cash that they need for closing. If they are low to moderate income, or if they're Black and Hispanic, it's much more likely they're going to need to go FHA or VA. In this case, that means that they're paying triple the closing fees that a conventional loan borrower would have to pay, and they're not getting a better rate for it. So you'll note that the rates on the right-hand side of the screen are very similar across the board. So the question is, of course, what are they getting for that price? And, essentially they're not getting very much. It's delaying home ownership, and it does make it harder for them to come up with the cash that they need to close. And let's take a look and break this down by race and ethnicity and see what the impact is on borrowers. Now we're looking again at home purchase loans. This is a scatter plot that lets us break out individual racial groups. And for the last couple of years, we've had a much higher degree of accuracy with our race data, since Asian borrowers, Hispanic borrowers, and Hawaiian or Pacific Islanders are allowed to choose from one of several subgroups to better identify themselves. And that's important because, as we can see, there are some variations here. So in the two counties that we're looking at for home purchase loans, for example, on the bottom we see higher closing costs as you get to the right, and on the left, as you go up, the interest rate is higher. So where you want to be as a borrower is somewhere down here in the lower left, paying the lowest amount to close on your loan and the lowest interest rate that you can. What we see here is, Korean and Chinese borrowers in the area, and although there weren't very many, tend to pay the least, and that's something that we see nationally. Filipinos, on the other hand, pay a lot more. They're usually up there with Black and Hispanic borrowers. In this case, for home purchases, white borrowers are right here. Median loan price or median closing cost of $4,200, interest rate of 4.5%. So this distribution isn't unusual, but what this is in part an effect, though, of Black and Hispanic borrowers having to use FHA or VA loans for the vast majority of their home purchases. So that's why you see them on the higher end of the closing cost scale. Let me see here. Now let's take a look at these top 20 lenders again. Again, we're looking at home purchases, but here we're looking at the share of their loans going to low to moderate income neighborhoods on the bottom of the screen. And on the left, you've got the number of loans going to low to moderate income borrowers. And again, where you want to be here as a lender is somewhere in this upper right quadrant, where you see a couple of banks there. And as you go down to the left, you see fewer and fewer loans going to LMI borrowers or in low to moderate income neighborhoods. We can also look at this by minority status. So here we're going to look at minority neighborhoods on the bottom of the scatter plot, and loans to minority borrowers on the left side of the scatter plot. And again, ideally, if we're looking at home purchase loans, let me see here, let me just wait for it to update. You'd want to be in this upper right-hand quadrant. Well, there we go, and let's just select home purchase. There we go. And again, you've got Fulton Bank in the upper right-hand quadrant. They were there for the low to moderate income borrowing as well. So that's a good sign. And they made about 1,938 home purchase loans. So generally, that's where you want to be in this upper quadrant up here. It looks pretty good. We also analyze business lending. Unfortunately, the data we get on business lending is not as complete as what we see on mortgage lending. And I'm going to skip through this to show the maps that we created for this. Interestingly, the pattern is mostly similar to what you see with the home purchase lending. The only difference being that the top business lenders, there's a little more activity in New York, which we'll see in just a second. Here are your top 20 business lenders by number of loans made and then by the average loan amount. The ones identified in gray are probably your credit card lenders. And then if you notice in blue, these lenders tend to make larger loans. M&T Bank averaged $211,000, Fulton Bank $238,000. Unfortunately, we don't have enough detail in this data to tell you much about where those loans are going to or who's getting them, but it does give you an idea of who the major players are and the type of lending that they're active in. And again, let's take a look at the map of this business lending. And like I said, generally York, again, within the city, you don't see a lot of activity. Otherwise, we see a pretty good distribution throughout most of the suburbs and rural areas. But this weaker lending profile within York is disturbing, just like it was with the mortgage lending activity. Let's skip ahead here to business lending by bank. So again, we've got the top 20 banks. We're looking at both counties. And on the bottom, we've got loans to businesses with less than $1 million in revenue. On the left, we have loans to businesses in low to moderate income neighborhoods. Again, you'd want to be somewhat up here in the right quadrant if your interest is in LMI lending or loans to small businesses. But really, depending on the focus of the lender, it's okay to see them anywhere in this top portion or anywhere over on the right here. That indicates a better focus on small businesses, and it gives you an idea of how they're really performing with the constituencies that we typically serve. And let's take a look at bank branch locations here. So there are 284 branches spread across both counties. 12% of them are in low to moderate income neighborhoods, and only 3% are in majority neighborhoods. Now, if you remember earlier, we looked at the demographics of the area. And this is pretty good in terms of branches in low to moderate income areas, but it does indicate that there might be a problem with branch availability in majority areas, since only 3% of branches are located there, but 6% of families live there. But each bank performs very differently. So let's take a look down the list and see how each of them does. And what you want to do here is kind of look for anybody that really stands out from the crowd in a good way or a bad way. And generally, when you get down here, you do see some players that you might want to take a closer look at. PNC Bank, Northwest Bank in particular, they've got a good number of branches, but a very low number of them located in LMI or majority communities. Same with Citizens Bank. There's an interesting pattern here, but as you get down to these smaller banks, it means a little bit less how many of them are in LMI or majority neighborhoods. On the right-hand side, we've got a list of all the banks by deposit market share size. So this gives you an idea of how important these banks are to the area in general. Fulton Bank holds the most deposits at a little over $4.2 billion. That's 22% of all the deposits in the area. BB&T comes in next, and then some other big players. The good news here is that you've got a lot of banks that share the market pretty effectively. It's not dominated completely by one or two large players. So there's a lot of banks in the area that are going to have assessment areas for CRA purposes. And that's important, especially if those banks are looking to merge or looking to close a branch. It gives you an additional avenue for a comment letter where you can point out their share of the market and how important it is. Let's take a look at bank branches again using the scatter plot process. Now on the bottom, we've got the percent of banks in minority neighborhoods, and on the left side, the percent of banks in low to moderate income neighborhoods. And again, you want to be in the furthest in the upper right here that you can be. And some of these are kind of smaller players. York Bank only has 6 branches, but 2 of those are in LMI areas and 1 is in a minority neighborhood. That's a pretty good share for a bank that has just 6 branches total. And if we map those branches, this is kind of similar to the pattern that we saw with mortgage lending and business lending. Generally speaking, you have a cluster near both metro areas, and then as you get out to the suburbs, it tends to thin out a little bit. A couple of points of concern here. First is in the central area to the south and the west of Lancaster, there's a huge area with no branches. And then within the city limits of York itself, outside of a downtown core area, there's really no branches available to the people that live there either. So those are a couple of areas of concern that we might want to take a closer look at. And we look at the same map, this time by minority population, but we already kind of know what the pattern looks like there. And then we also have an interactive map here that you can play with and explore where these branches are, pull up a little more detail on each branch and see where they're located at and who owns them. So especially, let's take a look closer into York. We know there aren't a whole lot of branches in York, but we can look here and see who is located downtown. And we do have one location. M&T has a branch in York itself that's not in the downtown corridor. Otherwise, you can see that there is kind of an exclusionary zone here within this Beltway area that's a bit concerning, quite honestly. So thank you for your time. I'm going to be available to answer Q&A at this point, but and if you want to follow along at home, the link in the chat, you can pull it up and explore the data in more.
Thanks, Jason, for your remarks on a truly fascinating report. Again, for all of you at home, if you have questions, please place them in the Q&A feature at the bottom bar. We're actually going to be monitoring these and giving them to Jason, and we're going to have a little chat. So, Jason, hi. It's so great to see you. We're so thankful again for sharing just an awesome, fascinating report. And I just want to stop and thank, if we could, our sponsors one more time as those questions are coming in. Thank you all. These are awesome. Again, thank you to our rooftop sponsors, Fulton Mortgage Company, a division of Fulton Bank, B&F Properties, and Santander Bank. And of course, to our framing sponsors, BB&T, now Truist, First National Bank, PNC, and Univest. So, hi, Jason. Thanks again for joining us. I want to first stop, as I've been asking everyone, although maybe it's a bit cliche, but I want to ask you how you're doing during this strange, unprecedented, bizarre time. How are you doing professionally, personally? Yeah.
Well, luckily what I do translates really well to remote work. So professionally, it's been fine. I get a little more time to work instead of sitting on the metro in the morning, so that's a good sign. But no, it's all about taking breaks for mental health, focusing on the positive and just taking care of my family. So no, but thank you very much.
Yeah.
This is a great event, by the way. It makes me really wish I had some bacon right now.
I know, right? Bacon and eggs. I love breakfast for dinner, so this is a personal favorite of mine. Okay, Jason, are you ready? Rapid fire
Yes.
questions. First
Oh boy.
one. Do any of the credit unions do enough loans to show up on a chart like this?
Yeah, that's a great question. So the report itself is interactive, and if you go to the chat, Lori posted a link to the report, and so did I. I also posted a link to my email, and a shameless plug for our newest report on public health and redlining. But to go back to the question, credit unions are part of this report. If you go into the interactive version, you can select just to see credit union data. However, in our top 20 list, none of the credit unions were able to break into that list with the mortgage companies and banks, but they're certainly there. We do not have them in this data set for bank branch locations. So we can do that. If a member's interested, we can certainly pull that data together. Just this report doesn't typically delve down into that level with credit unions.
Well, it's helpful to know that that information is there if needed.
Sure.
Next question. It seems that more consumers are doing online banking and event through smartphone apps. Some banks are in the process of actually closing branches as we're listening to this. So how will this change evaluating the availability of banking resources to the lesser banked community?
Well, in many ways, it doesn't. So the FDIC does a great survey every 2 years on household banking and how America banks. And in fact, they just released a new one. And we're going to be hosting a webinar in a couple of weeks with the FDIC research team to talk about it. So what has changed is not necessarily what branch, how useful branches are. What has changed is how people use them. So although more and more people are using mobile banking and online banking for transactions like checking your balance or depositing checks and things like that, the branch still fills a critical role, and the survey kind of indicates this. Even families that do all their banking online report visiting a branch at least once a year, and a large percentage of them visit it multiple times a year, typically more for information, problems, account openings and closures. And the link between small business lending and bank branch locations is very strong. When bank branches close in neighborhoods, business lending in those areas drops precipitously for several years. So yeah, I think they're still very important. And more importantly, the service test of the Community Reinvestment Act requires that there be bank branches that serve the needs of the community as well. So I think they're still pretty important. Just how we use them is changing.
So I'm in communications and marketing, and so I'm curious if the physicality, the physical location of a branch, out of sight, out of mind. Is there something about having a physical branch that makes a connection with home ownership or lending? I know I'm asking you more of an anecdotal question, but I'm just curious your thoughts in that regard.
No, it's a great question. Decreasingly, we see a link between branches and mortgage lending kind of fading a little bit as people. First of all, mortgage companies make most of the loans in the country right now anyway, and the mortgage process is highly automated. Business lending is a very different story. Business lending is highly relational. That may change over time, but it still requires, it still is facilitated by a relationship with somebody at a branch in most cases. The necessity of the branch, I think, isn't really going to change, but how we use it and how we relate to it certainly is. And there is an aspect of a branch being in a neighborhood that is a signal, right? It's a signal of investment. For smaller communities in particular, it's an important commercial tenant. And something that's not really talked about is that it's an important employer. A lot of people get into the financial services sector initially through the branch network, and then they move into other forms of finance work. But that's something that I think gets overlooked a lot. But it's especially important for women and minorities that are entering the financial workforce. A lot of times when you talk to them, you'll find that they started first as a teller somewhere.
Yeah. That actually leads very well into this next question as to what role do minority-owned banks play in home and business lending? And so second part of that is how robust of a footprint do these institutions have?
Yeah, that's a really good question too. So the FDIC does keep track. Every quarter they publish a list of their MDIs, minority depository institutions. Unfortunately, it's a small list, and it continues to kind of get smaller every year, it seems. Especially, we lost several of them after the crash of '08, and during the intervening time, several more have failed. They're capital constrained, which is a challenge, and currently we're seeing a move by a lot of the larger banks to invest in them just to bulk up their capital resources. There's a great book by a professor out of University of Georgia, Mirza Baradaran, on black banking and black banks, and I think that's kind of an important reading if you're interested in the topic.
That would be great, and maybe our crew could put that in the chat function to share with people, so that would be wonderful. That actually leads well, Jason, to talking around like what role does data have in this process? So, speaking to the report that you shared with us, how can we use this data to speak to our banking partners about increasing lending in majority-minority neighborhoods?
Yeah, so there's a saying at NCRC that data drives the movement for economic justice, and that it sounds kind of silly when you say that in a setting like this, but the access to and the ability to use data in advocacy is more important every year, I think, because the data gives you a window into what's really going on. Otherwise, you're left kind of interpreting it through anecdotes or what you see around you or what banks or lenders tell you. Unfortunately, the data gets to a point that it's complex enough or it's presented in a manner that's difficult to access for a lot of people. And that's where my team kind of steps in with members. We help them, pull together the data they need for their community and take a look at it in a way that makes sense to them. And by the way, you mentioned I mentioned Mirza Baradaran's book. I'm going to go ahead and put a link to her in the chat for the folks that were interested in minority deposit institutions. It's an Amazon link. I'm not saying you have to buy it through them, but it at least gives you the name of the book if you want to look it up and get it somewhere else. But she's great, and it's a great response to that question about MDIs.
Awesome, Jason. Thank you. So next question. These are getting longer, so bear with me as I read them too. Okay, here we go. Are most home buyers using FHA, VA, etc., because they have to due to lower down payments, etc.? So that's the first part. Is it possible they are directed into these loan programs due to higher fees earned by the mortgage companies? That's the second part of the question. And then this is more of a commentary. I assume the higher fees are mostly going to the originating bank, or do they go to the VA or FHA program?
Yeah, so you're talking about steering. Yeah. So that's a really well-crafted question, Carolyn. So first of all, they don't have to do anything. There are conventional loan products that mimic FHA. There's nothing really that compares with VA. Let's just leave that out for a second. The VA loan program is an amazing tool, and there's not a conventional product that really can match it, in my opinion. But FHA loans, there are the Home Ready program through Fannie. There's a Freddie Mac version of the same thing that offer essentially the same program. The low down payment requirements, the credit scoring, everything like that. They were specifically made to kind of mimic FHA lending. Yet we still see the lenders favoring the other. Where there's probably a whole lot of reasons why. And when it comes to the fees, maybe my sense is that a big chunk of it does go to the MI for FHA or the guarantee fee and stuff like that actually pushes the cost up a little bit. But generally the research on origination charges, which is the largest part of closing costs that we talk about here, is that it's opportunistic in nature. Mortgage companies, that's their one bite at the apple. That's where they make their money. They don't have another relationship with the lender. They can't offer them checking accounts or credit cards or anything like that. It's at the closing table that they get paid. And often if they're dealing with a customer especially who is inexperienced, that doesn't shop around very much or doesn't realize that a lot of those rates and fees are negotiable to some extent, then you wind up with higher rates and fees. So and certainly there's evidence of steering at some level, and we do our organization does match pair testing for some types of lenders, and mostly we do that for business lending, but at the loan origination level they observe steering pretty consistently.
So that leads well into the next question around, so you were speaking to almost limitations in the market. So what strategies should we explore to decrease dependence on government-backed programs that are more costly, especially as it relates to people of color?
Well, a few things. First of all, banks got out of FHA lending for a reason. It has to do with reps and warrants on the loans. They don't want to get stuck having to buy them back. Mortgage companies don't have to worry about that because they're undercapitalized anyway. They simply would leave the market. Repairing that relationship with banks and encouraging them to do that is one step, but that really doesn't solve the larger issue of higher cost. Encouraging banks to develop and expand on products that are conventional and have conventional cost, but offer the benefits of FHA would be good as well. There's nothing wrong with FHA. It's how I financed, at least two of my homes that I've bought in my lifetime, right? So there's nothing wrong with it, but you don't want to steer people into it who don't necessarily need it, and it'd be nice to offer an alternative that might be lower in cost for them as well.
Thanks. So last question, we have time for one more.
Sure.
I'm going to ask you to do a little comparison. How does the Lancaster/York communities, this report, compare across PA or at least to similar sized communities?
So it's very similar. It's very similar in a lot of ways to cities of the same size, especially inland cities that are away from the coast or away from that kind of, the coastal communities have a different dynamic because generally you have much higher home values in one area, that sort of thing. But it's very similar. I'm somewhat encouraged that let's talk about outside the city limits of Lancaster. Outside the city limits, I didn't observe any sort of patterns that were readily apparent, where areas were underserved. It's a little hard from my perspective since I don't know what's happening on the ground, but a local person can probably look at those and identify, if there are any deserts or anything like that. But in both cities, as soon as you get across the city line into the city itself, you see a pattern of less investment, less lending, fewer loans, and that's pretty similar as well, especially in older industrial cities, where inside the city you typically have lower priced housing, concentrations of LMI and minority people, and these are the kind of things that tend to drive lenders away. And so, we encourage, of course, adherence to the Community Reinvestment Act. There is a current rulemaking that we're commenting on right now to expand it and modernize it a little bit. And one of the things that we encourage is that the regulators use CRA to analyze whether or not banks are really meeting the credit needs of the entire community, not just the suburbs in this case. And honestly, two things gave me a great deal of pause with this report, and one of them was the maps of mortgage lending, especially in York, but Lancaster as well, and the other was in the extreme disparity in closing costs between conventional and FHA loans that were much higher than I'm used to seeing anywhere else.
Those are really good things to keep an eye on. Well, Jason, we're out of time with you, but we are so grateful that you provided expert thoughts and commentary and answering our questions on this really fascinating subject. We could chat about this all night, but people are going to be done with their Brinner soon. So thank you so much to you and to all of you who submitted questions. We're deeply grateful. And since our time is running short, please look for a follow-up email coming with additional information and a link to Jason's report.